Hello everyone. So now we are going to discuss about concept number 3. So in the previous lecture we discussed that all those informations which are related to the business, all those business informations which are measurable in terms of money are called as business transaction. Those informations related to business and which are measurable in terms of money are called as business transaction. For example, sale of goods for cash. You sold goods to the customer for cash. This is a business transaction which can be measurable in terms of money. Purchase of goods for cash. So all these are examples of business transaction. Now you have to understand that every business transaction is going to make two changes in the business. What do you mean by two changes? For example, let us assume you sold goods for cash. You sold goods to the customer for cash. Think from business point of view. Business has sold the goods. It means goods are going out of the business and we have collected the cash from the customer. So cash is going to come into the business. So goods are going out and cash is coming in. So it means that this transaction made two changes. One change in goods and the other change in which one? Cash. For example, purchase of goods for cash. You purchased goods from the supplier and you paid cash for that. So when you buy the goods, what will happen? Goods will enter into the business and cash will go out. So even here also there are two changes are happening in the business. So we say that every business transaction is going to make some changes in the business. And it will make how many changes? Two changes in business. This particular concept is called as dual aspect concept. This particular rule in accounts is called as dual aspect. We say every business transaction has two aspects in it, two changes in it, dual, double. So this is called as dual aspect concept. Now you understand that what are the two changes a business transaction is going to make in the business that we can classify into 5 categories. So whatever the changes will happen in the business, that you can classify it, that you can name it into 5 things. So those 5 things are, first one is an asset. So whenever any business transaction happen, assets of your business may change. It may increase or decrease, or expense of your business may change, increase or decrease, or incomes of your business, liabilities of your business, or capital of your business will change, will increase or decrease. So what are the two changes a transaction, a business transaction is going to make in the business that can be classified into any of these 5 categories? So if a business transaction has happened, it means out of 5 things something would have changed in the business. Either asset, expense, income, liability or capital would have changed in the business. These are the most important 5 terms of accounts which we need to understand. Now whatever these 5 items are there, we can group into 2 activities or we can group into 2 categories. 2 groups we can do for these 5 items. One group is for asset and expenses. Asset expense will come in one particular group. And income, liability, capital will come in the second group. So first group is for asset expense and next group is for income, liability and capital. Now understand how I have done the grouping of these 2 things. Why asset expense will come in the same group, income liability capital will come in the other group? See, listen. Whenever you buy an asset, whenever you buy any property or any asset, for example, building purchased, machinery purchased, furniture purchased. So if you buy any asset for your business, money will go out of the business. There is an outflow of money. Whenever you pay any expenses, for example, salary paid, rent paid, electric charges paid. So there also what is happening? There is an outflow of money from the business. So in both these cases, you can find that one thing is common, outflow of money. You buy asset or you pay expenses, one thing is common, there is an outflow of money. But if you find in these three things, income, liability and capital, one thing is common, that is there is inflow of money. For example, fees collected from the student, college fees or tuition fees collected from the student. So for me, it's an income. There is an inflow of money. I'm collecting the fees from the student. It's an income, inflow of money. Let's say I went to the bank. I took a loan of 10 lakhs. What are the 10 lakh of loan I taken from the bank? For me, it's a liability because I need to repay in future. So when I take the loan from the bank, even here also money is coming into business. There is inflow of money. Next, let us say there is one particular business and owner has invested the money into the business. So if you think from business point of view, there is inflow of money. Money is coming into the business and this money is being introduced or invested by the owner. So this is called as capital. Money invested by the business into money invested by the owner into the business is called as capital. So here also there is inflow of money. So in these three cases, one thing is common, there is inflow of money. And in these two cases, one thing is common, there is an outflow of money.